Finally, interest rate cuts are on the horizon. On the top of the interest rate cut we had in February, not one, not two, but three or even more rate cuts are predicted by Big Four banks. Today, I'm breaking down what's been recently announced, what the experts are predicting, and most importantly, what all of this could mean for you as a property investor. What we'll cover in today's video is recent announcements by the Big Four banks and their interest rate forecasts, and potential impacts on rate cuts, including on borrowing capacity. And lastly, my recommendation, what you need to do. Hi, I'm Eric Lee. I'm a chartered accountant with over 15 years of experience and property investment advisor holding a real estate agent license as well. So if you want trustworthy information about property investment, please hit the subscribe button and alarm button so you won't miss out any updates from me. In February 2025, the RBA, the Reserve Bank of Australia, reduced the cash rate by 25 basis points to 4.1%, marking the first rate cut since 2020. By the way, if you're not familiar with the term basis point, 100 basis points means 1%. Then RBA held the cash rate steady in April, and now things are getting interesting. CBA and Westpac are predicting 3 further rate cuts and one with a 50 basis points cut as early as in May. And ANZ predicts 3 rate cuts as well, but probably not with the double rate cuts. The double rate cut means a 50 basis point cut. But NAB went even further. As you can see, NAB predicted that the interest rate could decrease from the 4.1%, which we are holding now, all the way down to 2.6%, a massive 1.5% cut by February next year. So what does this actually mean for you as a property investor? If this plays out, someone with $1 million loan will be able to save $15,000 a year, 1.5% of $1 million. Simple. But here's the thing, smart investors don't focus on savings, but borrowing capacity, because the borrowing capacity creates the leverage, and this leverage is the one actually makes the richest richer. If you want more details on how leverage works in property investment, bookmark the video link above and watch it later. What 1.5% interest cut actually does is that it will increase your borrowing capacity by anywhere between 15 to 20%. Why? Because lower interest rate means less loan repayments, so your disposable income increases accordingly. And at the same time, the assessment rate used by the banks also falls. Therefore, if you previously had $1 million borrowing capacity, it becomes $1.15 to $1.2 million, meaning you could afford to purchase another investment property without having any additional income. This will give people on the sideline opportunities to get into the market, and this means that we may see the property prices move faster. It is not just because of the additional cash flow generated by the rate cuts, but it is more about the market sentiment. You know that the property price is all about supply and demand, right? When people see the rate cuts and expect the rate to fall even further, they will more likely to front run this. So we have already seen this during COVID. Falling rates triggered a surge in the demand and the market took off. And once the market starts moving, which I think it's already started, FOMO kicks in and buyer activity ramps up. Add to the ongoing housing supply shortage, which I already talked about in my previous video, and it is no wonder that many economists and other property experts, including myself, are seeing a high chance of a property boom on its way. And there is another layer of the matter. Some might think that rent will drop when landlord costs decrease due to lower interest rate. But that's not how it works. In reality, rental prices are far more influenced by the supply and demand than by the cost of the ownership. As you can see in the table, rental vacancy in Australia is low across much of Australia. Due to the current chronic housing supply shortage, which I already talked about, this makes the rate cut more likely to benefit the landlords, not tenants. Before I wrap things up, I would like to tell you one last thing. Don't forget to stress test your portfolio. Yes, rate cuts are coming, but we've seen how quickly they can rise again. So you need to make sure you are not just relying on short-term relief, but build in buffers, make sure your cash flow stacks up, and plan for the long term. In conclusion, yes, rate cuts are likely coming. The signs are there, and economic data is pointing that way. But how you respond to those cuts will determine whether you profit or just watch from the sideline. If you want tailored advice on what this means for your situation, especially when it comes down to property investment or tax planning, feel free to contact me using the details in the description below. And of course, don't forget to hit the subscribe button so you don't miss out any more updates like this one. Thanks for watching, and I will see you in the next video. Bye for now.